Okay, class, this is chapter 14. The back half of the chapter, first lecture was on bonds payable. Now we're going to talk about installment notes. Again, another time value of money, a problem, if you will. And so installment notes are pretty much like the mortgage example that I used when we talked about time value of money in chapter 6. And so we're going to buy something, or we could sell something, but this chapter is around liabilities. Buy something, and if we just make periodic payments, annuity streams to pay off this debt. And so each payment is going to have a part that equals interest and a part that equals principal. Let's see if let's come back here. So long-term notes, if you're the borrower, it's notes payable. If you're the lender, it's a notes receivable. So again, it's going to be an ordinary annuity, if you will, but each payment, with each payment, there's going to be an interest piece, and what's the difference between the payment and the interest piece is going to be a reduction of the amount that we borrow. If you think about a mortgage, every time someone makes a mortgage payment, there's a piece that goes to the interest, and there's a piece that goes and reduces the loan balance outstanding, the amount that's above the interest cost. Let's look at, here's an amortization table. And so here are 6 payments of $139,000. And this installment note was $666, I guess. Here is the outstanding balance from day 1, January 1. And this note gets paid off with 6 equal payments, just an ordinary annuity, of $139,857. So let's look at payment 1 on June 30th. And so we owed $666,633. And it was a 14% note, right? Divide by 2. Why? We're making 2 payments per year. And so we have 6 months of interest. So we only use 7%. And so the interest that we incurred for using someone else's money for 6 months is $46,000. However, we paid them more than $46,000. We paid them $139,000. So a piece of that $139,000 goes to reduce the balance. And so now, instead of $666, we only owe $573. Where did that $573 come from? It's a difference between $139 and $46, the $93,000. We reduced how much we owed by $93,000. Go to payment 2. Now we have $573 as the outstanding balance, and after another 6 months, months 7 through 12, we're going to take 7% times how much we owed at the beginning of this 6 months, $573, $40,000 of interest. But yet, we paid $139. So $40,000 of that $139 goes to interest. The remainder reduces our debt down to $473. By the way, if you have a car payment, which you guys probably have more car payments than mortgage, every time you make a car payment, a piece goes to interest, and a piece goes to reduce your debt, your car loan your outstanding balance. So at any point along the line, you can look and see how much your outstanding balance is. You might want to know that if you can go buy a new car, because you got this debt, you got to take care of the outstanding balance before you can buy a new car. So good to kind of know how this math works for your personal lives as well. And so journal entries here, just debit the initial, we bought machinery for $666, credit the note payable, and then here's the first entry, debit interest expense, debit the notes payable. So for this, we don't keep a separate face value of the note. That was only in the bond. So this is different than that. We just have one debt, the note payable. And so it started with $666, and now we've debited for $193. So now what's the balance? $573. And so here's our entry. How much do we pay? $139. And this journal entry just reflects the fact $46,664 of this $139 was for interest that we incurred. And the remainder reduces the notes payable amount. Debits reduce liabilities, right? So that's a $93,000 debit that does that. And so again, we're really towards the end of this chapter now. Everything about your debt is going to be disclosed. What are What are the maturity dates? What are the interest rates? What are call provisions? Any restrictions, debt covenants, assets pledged as collateral. So if you go to the debt footnote, we as a company will disclose a lot of information. If you're an investor, it's good to go to that debt footnote and look when there's their debt. I was recently looking to invest in Verizon, but they have something like, it might be, I can't remember, but 90 or 100 billion in debt. That scared me. And I looked at the balance sheet and I said, man, that is a big amount of debt. Now they were generating 30 to 40 million dollars of cash flow from operations, but I said, 100 billion in debt, because it costs a lot of money to go create 5G across the whole United States, right? And so they had to borrow money. Their source of funding, debt, bonds, and they got them at very low interest rates. So I went to debt footnote, and what I saw was interesting. Hey, a lot of these are out there. They don't have to pay for a lot of these. They're way out there. So I felt like, wow, that's pretty safe. They're generating $39, $40 billion a year in cash. They got plenty of time to pay off this $100 billion in debt. I felt pretty good about it, and I actually bought the stock. So I used the information that we're talking about here, because there's a lot of information there that gives you, that you wouldn't see if you just looked at the one number. Because I would not have invested in Verizon without looking at the debt footnote and know when the maturity dates were. That's what really mattered to me. I did look at the interest rates because they were super low. And so I felt really good about Verizon. We'll see how that plays out. Now, we can go out and buy the debt on the open market and extinguish the debt. We may even have call provisions where we can call all the debt. And so at that point, we are going to have a gain or a loss. And so we're going to have to be able to, and you on the exam will have to be able to calculate the gain or the loss on early extinguishment of debt. Now, here was, I'll tell you about how I think about this. Let's look at the example. I'll give you a second to read this. Take a look at and read that. So they called their bonds, and they had to pay $685 to call their bonds, and I think this is a year later. So this is a year later. I think these were January 1, 2018, and the book value was $676. How do I know that? $700,000 face value, and we had $23,000 sitting in the discount account. Here is how I would think about these problems. You know how much the call price is. Now it may not be $685, it may say 98 or 97. So you may have a bond price which is just 98 or 97% of the face value. So you may have a bond price, not an amount, but you can calculate the amount. Easy stuff. In this case, they didn't do that. We know $685. So credit cash for $685. Step one. Step two, go look at how much is in the bond payable account. In this case, $700,000 credit. Okay, I got to take that to zero, debit that. Next, go look at the bond discount or premium. In this case, we have a bond discount. It had $23,000, $712 in the debit balance, so I'm going to credit that. I'm going to get rid of it. If I had a premium there, that's a credit balance, I would debit the premium account. So in other words, I'm going to take the bonds payable amount count down to zero. I'm going to take the bond premium account down to zero with whatever journal entry I need. And guess what? I just got to see, what do I need? Do I need a debit or credit? If I need a debit, I have a loss on the early extinguishment of debt. If I need a credit here, in other words, my debits are greater than my credits, then I need a credit here. And so here, our credits are greater than our one debit of $700,000, so I need a debit of $8,712, and it's a debit, it's a loss on the early extinguishment. So again, step one, figure out how much cash you got to pay, credit that amount. Step two, get rid of your bond payable and your bond premium or discount by the opposite side of the debit or credit. Take that account down to zero, and then find out how much of a debit or credit I need, debit being loss, credit being a gain. Okay, now a lot of people, I know this is an exam question I've had many times in the past, and a lot of people miss it. They're in my office, really good students, and they say, wow, I don't know how I missed this one. And I remind them that during my lecture, I said, hey, this is going to be on the exam. Know this. And so they said, oh yeah, I kind of remember that. So if you're watching this lecture now online, hey, take a note to yourself. You're not going to remember, I would love it if you remember everything I talk about here now, but you're not going to. Take a note to yourself, hey, go back and look at detachable stock purchase warrants accounting before the next exam. And so what is and by the way, this is different than convertible bonds. Convertible bonds that can be converted into stock, the whole security is not a bond anymore, it becomes stock. So this is different than that. Inside this bond, we have a detachable, meaning a warrant to buy stock. I still get to keep my bond, but I have something else. I have this warrant that allows me an option to go out and buy stock at a low price, probably. Therefore, why do companies give any warrants like this? They want to lower their interest rates. They're giving people a bond and a little extra skin in the game. Well, from an accounting, guess what? These are two things, not one thing. Even though they're all in one big document, there's one cash amount that we've received from this bond. There are two separate financial instruments in there, and they need to be accounted for separately. So we look at the fair value of this one versus of the warrant and the fair value of the bond, and if that's 5% of the total fair value, we'll use that 5%, and we'll take some of the cash out that we received and record it as differently. If the issue price will be allocated between the two securities. Bonds issued between interest payment dates, that you could have accrued interest here. So bonds, and I think this is more not for an exam, but just personally, the bonds sell at their price plus any interest that has been accrued since the last interest date. And that's it. Lecture for chapter 14. Next lecture, we will work problems, bonds payable problems. And I think, again, problems where there's a lot more teaching that I can do inside the problems. I ask you to watch that lecture and be prepared. Thank you, guys.